Well, Josh, I'm not sure if what we're running here is a podcast or just a well-orchestrated scam, but somehow we've conned Luke Gromen into spending an hour with a couple of degenerate firemen this morning. Luke, welcome on the Blue Collar Bitcoin podcast.
I'm excited and happy to be here, so thanks for having me on.
Yeah, Dan and I are concerned about the invoice because when we receive it, this whole thing's going to collapse under that.
It's a good run while we had it.
Yeah.
How's your morning, Luke? What have you been up to? What does a morning in the life of Luke Gromen look like?
It varies. It generally follows some version of a weekly flow. So we publish a report Wednesdays and every Friday. And so Mondays, I tend to wake up, do a bunch of reading. If I do a podcast, it's usually sometime early in the week, a Monday or a Tuesday. Usually by Tuesday afternoons, I'm in the writing cave writing. I pretty much am reading incessantly, the white papers, Twitter, mainstream media, just anything I can get my hands on. I don't know what I'm looking for, but I'm just trying. I've equated myself to being a big catfish down at the bottom of the Ohio River. I'm just sort of laying there and letting stuff drift downstream, and if it looks interesting to me, I'll ingest it and kind of set it to the side, the things I find interesting, organize my thoughts. So then Tuesday, Wednesdays are usually about writing. Thursday afternoons and Fridays are usually also about writing, but it was interspersed with all of that. I've got client interactions, I've got travel, I've got baseball games, I've got taking my youngest kid to high school now that school seasons, school year started again. So there's a general outline to it, but one of the things that I love about what I do, and there's a lot of them, is the flexibility that it affords.
Luke, you are known as, or to be, one of the greatest macro thinkers out there, in our opinion. And this is going to be a big question right off the bat, but it's completely relevant, and this is what people want to hear. What is so scary about this? Two questions, actually. What is so scary about this macro setup, the way we have it in the world right now with the geopolitical tensions going on, and what period of time in the past, in your opinion, is this most similar to?
The reason it is so scary to me is the combination of things that have either never happened before, have happened before and have worked out badly, but they are far bigger in terms of the magnitude of the problem now versus in times when history has rhymed. And then the physical world nature of a lot of these problems, and by that I mean in particular peak cheap energy and some of the energy constraints we are running into at the moment, where these can't be papered over. When you flick on the switch in Europe, either the electricity comes on or it doesn't, and there's nothing a central bank can do. And if anything, they can make it worse by printing money into an economy that is short energy. So you have this unique combination of peak cheap energy where we are trying to do this energy transition. And I've heard people say, well, the Stone Age didn't end for lack of stones. And of course it didn't. It ended because the Bronze Age came and bronze was better than stone. And the people with stone swords got killed by all the people with bronze swords, and so on. Coal overtook wood and oil overtook coal. And here we are for the first time that I'm aware of in human history as a global planet trying to make an energy transition from an energy source that is superior to inferior in terms of its energy return on invested energy, in terms of its portability, etc. A lot of different sort of physics factors. But the point is that we're trying to do this, and this would be difficult enough. Individual little civilizations on an island here or an island there, when they've tried to do it, they've generally gone extinct. So that gives you an idea. Now, we're trying to do this worldwide, so that the stakes could not be higher. complicating this is that you have these debt levels globally where arguably we started hitting some of these physical world thresholds 50 years ago. You can go back and read some of the limits to growth books and some of these things, and people say, well, the growth we've had since proves that was just Malthusian bunk. And on some level, yes, because we have made massive productivity increases, etc. But they also, those people calling that complete bunk, tend to leave out the fact that a lot of what we have done is basically pulled forward future demand by growing debt massively. Right. And so it's this interplay of this energy transition that is going to be difficult to do under the best of circumstances, with the debt, which complicates it. And now when you layer the geopolitical on it, where really what we need is cooperation and what we're getting is conflict, it just sets up for a very toxic brew from a macro perspective.
Could I just interject here for 1 second? I want to make sure I understand, and maybe everyone listening does, the transition in energy that you're speaking of. So we've gone from less dense energy sources throughout history to more dense, more productive energy sources. And what you're saying is that this maybe like solar, wind energy source option that we have in front of us is obviously less dense, less useful, and it has downtime. So we're actually moving to an inferior source of energy in a lot of ways. And that has cascading effects through the economy because it simply isn't as, you can't depend on it as well. And it's less energy dense. Okay.
Density is a great way of framing it, right? And ultimately, you've seen me probably say on Twitter before and in interviews that energy is the master resource, right? So we're watching this real time in Europe, which is, I think Zoltan Pozsar said the other day that $2 trillion in German value added is dependent on 20 billion in Russian gas. And so if you really, that 20 billion in Russian gas in that example is just nature's discount rate, right? The Fed can say, hey, we're going to lower rates, or the ECB can lower it. Nature doesn't give a shit. Like if the gas is going up in price, the discount rate of all assets, the discount rate on all assets is going up if the cost of energy goes up. And as that happens, the value of assets comes down. And the problem is, if we were an equity-based society, in other words, we didn't have all this debt, it was all equity-based, it wouldn't be a big deal. People write down their equity and we move on. It is what it is. But the challenge in a system that is a debt-backed system, debt-backed currency, is when you start writing down the value of assets, you're writing down the value of collateral against an extremely high debt load. You quickly get upside down. It has these broad-ranging macro implications that are, to put it mildly, problematic.
Yeah, so it's funny, you brought up Zoltan before I did. We read his most recent piece, War and Interest Rates. We talked about it with this guy, Joe Brown, the other week. In our view, like that was maybe the most impactful essay we've read in 6 months to a year. Not that we agree with everything in it, but it does rhyme a lot with your thinking, your writing. Like I immediately thought of Mr. X interviews when I was reading Zoltan's most recent piece. There's sort of three things at play, and I think it's worth.
I think he's ripping you off.
Yeah, plagiarism.
I doubt it. He's brilliant.
I think it's worth kind of going through all three, or at least a couple of these, and you just identified them again. You've got things, this confluence of really significant factors right now in the 2020s. An energy issue, huge exorbitant debt loads that have virtually no feasible escape without pain, and then conflict, right? Let's go back to the energy piece in whatever fashion you feel is most helpful. Explain what is so dire about this. How significant do you think it is? What's going on in Europe for someone that's maybe less clued into the dynamics right now on the energy crisis over there?
So I'm trying to think of the best way to frame this. I mean, to me, it's interesting. You hear, well, fiat currency is all about confidence. As long as there's confidence in the fiat currency, then the system works. And we've heard that our whole lives, and it's right. But they never get into the ephemeral they, right? Mm-hmm. Policymakers, our professors, economists, politicians, they never get into what underpins that confidence. And the answer to what underpins that confidence is when you turn on the lights, the light comes on. When you go to the gas station and you hand them those dollar bills and you squeeze the pump, there's gas in the pump. When you turn on the heat comes on. And when you start to disconnect it doesn't have to be all the time it doesn't work, just part of the time it doesn't work. When they say changing the mindset around inflation, this is ultimately what changing the mindset around inflation is. It's a change in perception about the risk, the consistency with which the paper fiat currency world can be exchanged for the real things that we need. And whether that's oil, gas, electricity, food at the, when you get real extreme examples down in Venezuela or whatever, where the shelves are empty, etc. It breeds this mindset of as soon as you get some money, you immediately put some of it into something other than money,
right?
Because you don't trust the supply chain of modern economies. And what we're watching in real time in Europe as a result of a combination of long-term diplomatic decisions by the European Union vis-a-vis Russian dependence on Russian gas. More recently, American unwillingness to let the Europeans have energy sovereignty around paying for energy in their own currency and settling in whatever they want to settle in. And then I think Russian intransigence around, on one hand, there's some issues there. On another hand, nobody likes having missiles on their border. We showed that in the United States in 1962 with the Cuban Missile Crisis. Yeah. So it's a complicated, not black and white, shades of gray, but where it's not shades of gray is on the energy side in real time. We're all seeing these charts of European power costs as a result of a restriction in gas flow into Europe, and it's not just problematic. I mean, it is catastrophic. It will not take long. Somebody tagged me on Twitter today where it's, hey, we run a small business in the UK. We just got our updated energy power costs. They're up 5x. We can't afford it. We were already losing money. We're shutting down. We're laying everybody off. And that's what I mean about energy is nature's discount rate. Take the discount rate up 5x. Business doesn't go down a little bit. Business doesn't drop 10% or 20%. Business drops 100%. Unemployment goes up non-linearly with nonlinear increases in nature's discount rate.
Absolutely. This seems to me like two forces meeting each other. There's this political science, this soft science of politicians deciding by fiat what's going to happen. And they're very used to, especially in the US and Europe, to be able to make those proclamations, and they can follow through, and it works because we've had such abundance of energy and just money in general. We've just been this first world part of the world for so long that we're used to just getting our way. And then in direct confrontation to that is physics or hard science, which is there's only so much energy, there's only so many resources, and now we've kind of met this rock and hard place where clearly physics and natural law is going to prevail over economics and political science, because those are just constructs of our minds, not really reality.
I also think there's just a massive naivety on the implications of this system imploding. Like, we see this a ton in the Bitcoin community, Luke. Like, you have what we call like some 3-book econ experts. They've read like 3 books by Bitcoiners, and all of a sudden they have this fundamental grasp of econ, of the fiat system is inherently evil, Bitcoin's going to sweep in, and there's going to be this great Bitcoin rapture. It makes me think of this interchange I saw with Bitcoin Tina. I don't know if you know who he is, but he was basically confronting this guy on Twitter yesterday saying, like, you've benefited. Like, do you enjoy eating and sleeping indoors? Like, these aren't just numbers on spreadsheets. Like, these ledgers, no matter how fragile they are, no matter how broken they are how the world works. They are how resources move, how lights go on, how air conditioners fire up, how heating gets in your home. So, yes, is the system broken and dysfunctional? For sure. But to wish for its immediate implosion is also wildly naive. And I appreciate your tone on this too. Like, yes, it's an absolute shit show, but we have to figure out tangible solutions that allow Homo sapien to continue to exist and thrive through whatever the transition is. And it just feels like a lot's coming to a head right now with the energy implications now entering the fray. I mean, just looking at these bills, for example, that people are posting on Twitter that live in Europe, of their natural gas bill, it's
insane.
Hard to wrap your head around, especially for a couple of middle-class dudes. When you're seeing a heating bill or an electricity bill that rivals your mortgage, that's not sustainable for my family. I can tell you that much. And so the point I'm getting at is we shouldn't be rooting for destruction. And I do think obviously you're sounding some really significant alarm bells that have significant implications.
Yeah. If you're, Dan, I think I'm just going to take it right out of your mouth here. Sorry. If you're Jerome Powell, Luke, how would you approach this? Would this be, would you take the same
straight
approach?
out of my mouth? God,
reached right through. You know what? You went long enough. It's enough.
Yeah, it cut me off.
How would you handle this if you were at the helm at the Fed? Like, what would be your playbook? If anything different from what's going on now? Because I mean, it is in the end,
Luke.
It's a confidence game, right? It's a confidence
game in the short run, and to you guys' point, in the intermediate term, it's a physics problem. And physics don't care, right? It's like honey badger. The fix is multi-pronged, and the problem is he only has control over one of the sticks, right? So it would be, it'd be like you guys showing up at a fire, and you've got, you guys have control of the end of the hose, but you don't have control of the friggin' water, right? So it's all you're going to have is a really expensive for the building owner light and sound show. You're not going to actually be fighting a fire.
That's firefighting anyways, Luke. You just uncovered. you just uncovered. Oh fuck, dude, Josh, we're
going to have to cut this part, Dan. We can't let that.
He's on to us, dude.
Right.
Really expensive light show, Luke. We won't get into that.
You need a very whole of government approach. You need sound energy, and you almost need, where we are, Manhattan Project-like urgency.
Yeah.
In terms of creating the nuclear bomb fast. You need basically, I think the answer is Jerome Powell. If I was him, my job, I would see it as financing U.S. industrial policy and the energy transition. Inflation be damned. We need 100 new nuke plants. Done. We need new infrastructure, electrical grid infrastructure. We need actually the steel mills and the ore and the mines to produce the stainless steel in sufficient quantities to build the electrical plants. And then once we build the steel mills and the electrical plants, then we can actually build the infrastructure, Fed monetize, all of that. Basically, you put the Fed back to where they were in World War II, which was the Fed said, we'll buy every Treasury that you offer, U.S. government, at and cap rates. And the Fed's balance sheet rose 10x during World War II off a small base.
I was just going to say
that's what he can do.
Your angle on that is entirely different from, I mean, most people that are in the space are just thinking financially all the time. And like, this is the way I would, obviously we all understand the supply side of all of this is totally outside of the Fed's control. But I mean, what you just enumerated there makes a lot of sense, because the underlying fundamental problem here, besides the fact that we've just printed money into an oblivion state, is that we have a scarcity of resources, specifically energy, and we need to get on top of that as fast as possible with, and nuclear energy is clearly the cleanest and best source of energy that we've invented thus far.
It is. It's fascinating to me, and it's a little disheartening. I think it's very cynical, dogmatic, I can't decide what it's from when I hear guys like Larry Summers or guys like Bill Dudley talking about needing to reduce demand to fix the inflation problem rather than investing in supply and just letting inflation run hot for a while. I go back to the movie The Big Short. I presume you guys have seen the movie The Big Short,
great
right?
Movie.
And it's a great movie. And, I go back to the scene where Brad Pitt's character, Ben Rickert, goes, do you guys understand what just happened? What you just did? You're betting against the American economy. Here's a number for you. Every 1% that unemployment goes up, 40,000 people die. Just stop fucking dancing.
Mm-hmm.
And basically what Larry Summers and what Bill Dudley are recommending that Powell do when he's listening is to take unemployment up 2%, 3%. That's not going to stop the inflation. They need to take unemployment up 4%, 5%. So they are basically recommending killing 200, 300,000 people to get inflation down so that the real value of their bond portfolio can be maintained at a time of record wealth and income inequality anyway. I mean, it is so distasteful to me. Away from distasteful, because that's a political question, it's so the wrong thing for the United States economy, the United States government, the United States people, that these policymakers are allegedly acting in the interest of, that I find myself very frustrated. The answer is listen, if you didn't want inflation, you shouldn't have done all this stupid stuff. Because the inflation is just the market marking to market all the stupid stuff. Instead of building new bridges and new infrastructure and new this, like we deployed a whole bunch of steel and we put them into athletic stadiums like the last days of Rome.
Yeah.
What if all that steel and all these billion-dollar stadiums that, they go down to high school football stadiums these days. Like, I mean, when we were playing football growing up, like it was like you had one jersey and like the wood stands were wood and the fields were all grass. And that's fine. Like I don't want to take anything away from these stadiums, but they're sort of way down on Maslow's hierarchy of needs.
Agreed.
If you're not addressing your infrastructure, your energy, your power. And then we can get into economic policy. We can get into the wisdom of offshoring the U.S. industrial base to China. We can get into the wisdom of what we did in the Middle East and all these things, which were bad ideas, very expensive, put us behind the eight ball. Like the inflation we're seeing at its core is just the marking to market to all of those bad decisions. In the same way that the inflation of the 70s, the U.S. having to go off the gold standard, was a marking to market of the bad decision, primarily of going into Vietnam in the way we did. Mm-hmm. So for me, it's very, it's disheartening. They really need to, what they should be doing and what they are doing are literally opposite sides. And what that tells me is, okay, like the beatings are going to continue until morale improves or until people go, that's it, right? Like we need to print the money to invest in these shortages. The only way to stop the inflation is to let the inflation run hot, invest, and that's the market's giving you a signal. Hey, prices are going up. It doesn't tell you to run unemployment up 5%. It tells you to go build some damn electricity plants.
Yeah. Let's take a quick break and hear from our show sponsors. The BCB podcast is sponsored by Capital Logistics. Capital Logistics is a freight broker connecting truck drivers and shipping partners around North America. A true blue-collar business that supports blue-collar Bitcoin. They specialize in temperature-controlled cargo, efficiently hauling food, supplies, and other freight nationwide for some of America's largest companies. Capital Logistics is a firm believer that people and businesses should be able to save what they earn without having their purchasing power manipulated by the financial system, ravaged by inflation and currency debasement. As early adopters of innovative systems throughout their business, Capital's excess cash flow is put into Bitcoin every month. If you're someone that wants to work with a company that shares blue-collar values and an affinity for Bitcoin, reach out to Capital Logistics today. Find them online at capitallogisticsllc.com. That's capitallogisticsllc.com.
What if you didn't have to pay healthcare premiums anymore? What if you could invest in Bitcoin instead? With CrowdHealth, you can put aside money for health expenses in your own account and even hold a large part of it in Bitcoin. If Bitcoin goes up, you get the upside. Not big insurance companies. Pay one low monthly total to fund your account that is yours. Choose your doctors and hold up to 75% of the funds in Bitcoin. If a large expense comes up, CrowdHealth will crowdfund the bill for you to pay quickly. Stop supporting the broken health insurance system with your hard-earned capital. Go to joincrowdhealth.com and use code BLUE now and experience freedom from health insurance by utilizing Bitcoin. Right now, you can get your first 6 months for just $99 per month. That's a fraction of high-deductible insurance plans. Go to joincrowdhealth.com and use code BLUE to sign up. That's joincrowdhealth.com, promo code BLUE. Crowd Health is not insurance. It's a totally different way of paying for healthcare. Terms and conditions apply.
BCB Podcast is sponsored by Ledden. Ledden is a very unique financial services company with a highly principled, Bitcoin forward perspective. They are the first ever digital asset lending platform to undergo a formal proof of reserves attestation, where an independent public accountant regularly confirms that the company is properly accounting for client assets. Simply put, this company mirrors and embraces the transparency, accountability, and auditability of the Bitcoin protocol and network itself. If you've listened to BCB, you certainly noticed that we advise our listeners to be careful, manage risk, and never get over-leveraged. And that does include ensuring that any borrowing and lending decisions make sound mathematical sense based on your lifestyle and specific situation. Where available in your jurisdiction, Ledden offers a menu of powerful financial services. Keep ownership of your Bitcoin and access dollar loans with Ledden Bitcoin-backed loans. Harness your Bitcoin holdings to buy a new property or finance the home you already own with the upcoming Ledden Bitcoin mortgage product. Save Bitcoin and USDC to have access to Ledden dollar loans and their trading service if available. You can look into Ledden's well-architected menu of services at ledden.io, that's LEDN.io, and visit start.ledden.io/blue-collar-Bitcoin and sign up to get $10 USDC for creating and funding an account.
Blue Collar Bitcoin Podcast is brought to you by arguably the most legendary company in Bitcoin, CoinKite. Established block 141,000, CoinKite is an industry leader in security and signing devices. They are also the producers of the renowned Cold Card, the world's most trusted and secure Bitcoin signing device. Built with a plethora of features fit for Bitcoin beginners all the way up to the most advanced users. This device is a one-stop shop for your Bitcoin custody needs. CoinKite also manufactures the Block Clock, a gorgeous e-ink digital art piece sitting in the background of every serious Bitcoiner on planet Earth. Block Clock can be programmed to scroll through key Bitcoin metrics including price, hash rate, next halving date, and much more. They are also the makers of the Open Dime, a small USB stick that allows you to spend Bitcoin like a dollar bill. Pass it along multiple times. Check out CoinKite's whole suite of products, including the Sats card, tap signer, seed plate, and that honey badger hat you know you've always wanted at coinkite.com. Use promo code BCB for 5% off select purchases, including the Cold Card, at coinkite.com.
Now back to the show. As you say this, I don't know if this is going to resonate with either of you, but it's almost like if we were to employ that tactic, we need to do it before the rest of the world really catches on, because we're kind of thinking through this under the paradigm of USD is the world's reserve currency. Like, I actually have a quote written down here from Mr. X, and it stood out to me. What really gives us leverage is the position of the dollar as base currency. In the last financial crisis, we escaped largely by printing money. Other countries can't get away with that without causing massive inflation. So if you're basically sitting in Beijing, they've been catching on to this. You know, you'd think globally, right? They're denominating energy in something other than U.S. dollars. They're not net buyers of U.S. treasuries. And if we kind of lose this exorbitant privilege, although it has many disadvantages, and you enumerate those well for the middle class, it does enable us to take on massive leverage without full consequence, you could say. I guess this parlays into my next question. Like, could this be the real massive fly in the ointment? Like, especially when we layer on everything that the U.S. is obligated to spend on, entitlements, defense spending, just interest payments alone, right? When you add the debt situation and the fraying of global confidence in the USD as world reserve currency, this is where I guess the catch-22 really meets. Fill in anything else you want there, Luke, about how that complicates the dynamic of the U.S. sort of spin moving out of this situation.
Yeah, so I think there's fraying confidence in the dollar for various reasons. I think the fundamental reason for it is this recognition that the amount of dollars we will have to print to satisfy our debt and off-balance sheet obligations does not match the fundamental value of energy today. That if those two matched, energy prices should be way higher. And I think ultimately, this is why Russia 14 years ago said, we're done. We're going to start buying gold. Because I think they looked and said, we have a finite amount of oil. Sooner or later, our oil fields are going to peak, roll over. And if we only sell that for dollars or paper dollar denominated assets, we're going to wake up. As soon as Russian oil rolls over in terms of production, global oil prices are going to shoot up and the global economy is going to come unhinged. And that was speculative up until about 6 months ago. That's no longer speculative. We now know empirically that if you start reducing Russian oil supplies, inflation is going to take off, oil prices are going to spike, and the global economy is going to implode, because we're watching it happen real time in Europe. So there's this, and I think the Chinese, as a more centralized authoritarian government, has a little bit more flexibility. And I'm not saying it's a good or bad thing. I like our system better. With that said, one of the advantages, they can look at this and not have to deal with, not in my backyard and greens and all this stuff that the Europeans and the Americans have to deal with from a political standpoint. And they can go, oh my God, the Americans have to print $100 trillion and oil's only priced in dollars and we're short oil. And when the Americans print $100 trillion, our energy bill is going to go through the roof. We're going to run deficits and our economy is going to collapse and we're going to be hung by our people. That's the only thing they've been focused on for 15 years since the great financial crisis.
Yeah.
So you can see this move to gain the ability to price energy and other critical commodities in Chinese yuan. They are getting very far along on that process. The Europeans have been working at this for 50 years. You can go back to the state declassified State Department documents in which Henry Kissinger, before I was born, 1973 or 74, talking about how the European community at that point, it wasn't even the EU, it was the EC, how they were setting up a system, the French and the Germans and the Dutch, for settling, for paying Arab oil exporters in their currencies and settling the deficits in gold at a floating price instead of dollars. And so this has been this whole get away from the dollar thing. People say, well, it's going to take decades. Well, yeah, it's been at least 5 of them already. And the Americans have done a very brutish job of basically staving all of these off. And so, yes, there is a movement away from the dollar on some level. I think it ultimately is being driven by varying levels of fundamental enlightened self-interest by each of these countries, whether they be oil exporters in the case of Russia, or they be creditors to the U.S. that also import oil, like the European Union, like China, like Japan, like India. And we're seeing these headlines come by real time. People starting to, there's 2 ways out from this. So 3 ways out, really. It's we all work together, or we work separately. Someone comes up with some sort of productivity enhancing energy technology, or it's a Manhattan Project like that, nuclear fusion, massive rollout of fission, portable nuclear, salt bed reactors that you've heard people talk about. That may actually be further along than people think. Okay, great. That can get us there. That's still bumpy, but that's okay. Some sort of widespread economic collapse or conflict, not good. Or you get a jailbreak or a murder on the Orient Express outcome for the status quo dollar system, where Japan goes out and said, listen, it comes down to our people and the dollar, and we have to approach Russia and say, we will pay in yen. Yeah. And you take the yen, Russia, and then you buy Japanese goods, and anything net back or forth with each other, we will settle in gold at a floating rate. And the Indians already look like they're doing that, and the Turks have already started to talk about that. And the Europeans, I think, are conflicted. I think half the Europeans are with the Americans, and I think half the Europeans have wanted to do this energy and euro thing forever, which is, I think, why they did Nord Stream 2 and Nord Stream 1 and sort of got into bed with Russians in the first place. So there's all these things happening, but on the status quo, if nobody moves, like we're on a plane that is on a glide path at a pretty steep angle downward toward the ground at a pretty high rate of speed, unfortunately, economically speaking.
I was going to say, it's almost like when you look at the energy dynamics and, dollar being the network effect currency of energy trade, which we've established is increasingly less the case, but is still largely the headliner. It's almost like these other players are realizing they're the elephant and the U.S. is the handler. Like, you guys ever at the zoo where it's like, this elephant could just fucking crush this guy right here, but it doesn't know any better, right? And as you think about how big of an importer of oil China is, how massive Russian oil production is, which we've gotten a front row seat to, as you said more recently, how systemically important they are. It's like, this has been going on, and you talk about this a lot, but people are waking up internationally to the implications of them being prodded along by the handler when they're 10 times his size. You know what I mean? And it's absolutely something that needs to be squarely on the United States radar, and in many ways has been, but has to be kind of kept hush-hush.
I get the feeling, and Luke, let me know what you think about this, and I think it's fairly obvious at this point, though, that Powell is focused solely on the dollar at this point. Like, he wants to rein in inflation so that he can slow down the bleeding at least. And it seems like he's willing to throw almost anything under the bus for it, including jobs, the economy. He's going to raise interest rates to the point where very likely we have an economic problem instead of a dollar problem. And we kind of have to pick one or the other. Do you have any feeling or idea where you think interest rates could possibly go with this before maybe they change and turn tail and go the other direction again?
I think it is all around the Treasury market. I think they will raise rates and break stuff until the Treasury market breaks. And you can see ahead of time the symptoms of breaking are, the immediate symptom is when you get risk down, stocks down big and TLT down big, right? The ETF of so the long bond in the U.S. tanking with yields up, price down with stocks. That's your closest symptom. I would say the leading symptom to that, or a leading symptom to that, is watching tax receipts. And that's something people just aren't paying enough attention to, in my view, which is, yeah, we had a bubble in real estate. Yeah, we had a bubble in crypto. Yeah, we had a bubble in tech. We had all these bubbles, and everyone's like, oh, we got to do something about these bubbles. And none of those same people, other than maybe me and a couple other people, are going, did you guys see how much of a tax receipt bubble all those asset bubbles drove? Because we're barely covering Treasury spending and entitlement pay-goes with this epic bubble in tax receipts that was driven by an epic bubble in everything. And now the Fed's pricking the everything bubble. And we have a chart that shows that we've shown our clients a number of times. If you just look at the year-over-year change in stock prices against the year-over-year change in U.S. tax receipts, like post-95, there was a tax change that Bill Clinton signed and put in place that increased the incentive to make stock-based comp much more prevalent than cash-based comp for execs. And ever since then, it's been an increasingly tight correlation between whatever stock market does, that's what U.S. tax receipts do. And so now we know what stocks have done. We know what housing is doing, which also is very positively correlated on a lag to tax receipts. And so last week, Thursday or Friday, California tax receipts in July come in 12% below expectations. Stocks, houses. New York City estimated tax payments down 31% year over year in June. Right? I mean, you guys work, doing what you do in municipality. Like, it doesn't take too many money months at down 30% in a municipality where that's not good.
Yeah, things get squirrely.
So those are your leading indicators, right? And there's some things where people are leaving California and New York for a number of reasons, in part because the tax basis, the burdens are so high.
Right.
But at the end of the day, federally, the marginal a huge marginal driver to consumption is stock prices. Huge marginal to GDP is consumption.
Yeah.
And so we can see these things. It's very predictable. And so, okay, stock prices down, tax receipts down, stocks down, Treasury market down at the same time. Ultimately, the Fed has three mandates. They've always had three mandates. It's stable, low unemployment, stable prices, and financing the government, making sure the U.S. government's borrowing rate can borrow at politically expedient rates. And they sort of never had to worry about that. Well, that's the whole point of a central bank. When push comes to shove, it's just for all of our time on this planet, it really hasn't come to shove, not since 81 or 82. Now push is coming to shove again. And the Fed told us in 2020, April 2020, Powell said, used the phrase Treasury market functioning, Treasury market dysfunction. We need to make sure markets are functioning, Treasury market's functioning. He was asked, why are you still buying mortgages? Home prices are rising at a 25% rate. He said in either 20 or 21, I forget which year, but the quote blew my mind because he was honest. He said the MBS market, the mortgage-backed market, is a close relative to the Treasury market. So we have to keep it functioning.
Yeah.
There you go. So that is when they're going to stop breaking stuff. And that's where things get interesting, because I think things are going to break in the Treasury market in some way, shape, or form well before inflation gets back to, at the CPI level, back to their 2% target. And now you're going to be running sort of an Argentina central bank playbook with American characteristics, which is he's going to have to grow his balance sheet again. He's going to have to cut rates. He's going to have to stimulate with CPI still at 4 or 5 or 6. And it's just kind of
it's going to get interesting.
How it goes. It is what it is.
Yeah.
Man,
before I want to talk about Bitcoin here, but I want to ask you one more question on that topic before we do. Considering that tax receipts might be down considerably and interest rates are going up, so now you're in the situation where they have to keep maintaining this large debt load under that duress. So we talked to Joe Brown about this a little bit, and he had an idea that I hadn't thought of and I hadn't heard anyone speak about before, which is they might be able to change which, bond they're issuing. Like instead of issuing the short-term 3-month, 1-year Treasury bill, we go for the 10-year because there's a, much lower interest rate to maintain on that. Do you think that they would make a transition like that before they would do something like yield curve control to try to kick this can a little bit longer? Do you have any, I know that's kind of a complex topic, but if you've got some kind of brief answer for that or some idea that you've enumerated before, any ideas on that?
The short answer is they can do it on the margin. The problem is the sizes that they need to do it at now are so great relative to the underlying liquidity of the 10-year Treasury market, or the 20-year Treasury market, 30-year Treasury market, that
there's no buyers.
The 10-year there's not enough buyers for the size they need to do, and that's the policy rate effectively of your real economy, right? You show up and you start sending yields higher on that, you're going to break the housing market, and what you're going to find is your attempts to term out the debt actually increase the deficit, not lower the deficit. And and that's the problem when you get debt so high, is it's like a person.
Yeah.
Right? You get your debt so high, you have less and less and less flexibility, and that's just the issue.
So then beyond that would be yield curve control. They would have to at that point, because
some way, shape, or form.
Yeah. Okay.
Yeah. I mean, the issue is if they get started, they end up doing almost all of it. You know what I mean? When you've said that too, like it's non-linear. It's once they get going and people know they're getting ripped off, well, guess who's buying it all? And that's where it gets real sticky.
Yeah, that's a Hotel California.
All right, let's talk about Bitcoin. Let's throw it out to you at first. How would you characterize Bitcoin right now? Interesting? Is it really important? How likely do you think it is to be really valuable, and why? Give us just some high level comments on Bitcoin, and then we'll kind of prod from there.
So I still think Bitcoin is effectively a neutral reserve asset for the people that is tied to energy via the proof of work dynamic and the expenditure of energy, which I think is super important for people to hold a little bit of, at least, as a preserver of purchasing power in energy terms. As really a hedge of currencies, effectively, right?
Yeah.
It's what we're seeing, and I think it's been a very good measure of dollar liquidity in that way, right? I mean, Bitcoin, and I kick myself about this. I go back to last June. I said to my clients, to subscribers, I said I sold most of my Bitcoin and I'm paying down a lot of my debt. And I want to say Bitcoin was like 48,000, something like that. And it ended up being a fine trade. I started buying most of it back too early, starting in sort of 4Q into 1Q. And reason I say I kick myself, I don't kick myself about that so much, buying it back. I didn't trade it that well, obviously. But I'm in January of this year, I showed a chart of the price of gold in Weimar German marks, German Reichsmarks.
We're familiar with that chart.
Yeah, it's a great chart by my friend Dan Oliver at Mermacan Capital, and it shows that basically if you were levered long gold, even as the currency went to zero in gold terms effectively, went to $1 trillion per ounce of gold, you lost all your money 4 different times because of the volatility was just absolutely insane. And I actually put that in a report, and I said, here's where we are right now for Bitcoin and gold and all this stuff, and it was at like one of the tops before it went down and then took off higher still. And sometimes you get so caught in like the writing or the thinking that you don't exactly recognize exactly how important what you just wrote till you look back at it a little bit later. And I should have just said, I'm buying dollars and I'm buying a little bit of gold and I'm buying oil and I'm going to the beach and I'll see you guys all in December, because it would have been a lot less stressful year, but a lot less interesting year as well.
Yeah.
But my point here is that even in one of the great hyperinflations in history, and I don't think that's where this is going. I mean, it could, but I don't think that's where this is going. But even in one of the great hyperinflations in history, there were multiple times where the populace said, oh, they're serious this time. They're going to raise rates. They're going to tamp out inflation. I need to sell gold and buy German Reichsmarks. And of course, in history, you look back and go, how stupid was that? How could they have been so stupid? The math is obvious. And it's this whole thing, whether it's economics, life, raising kids, it's a lot harder in real time. It's easy to look back and go, oh.
For sure.
Absolutely.
You know? So to me, I think everyone should own a little bit of Bitcoin. And I think that varies on your own personal circumstances, understanding. It's a neutral reserve asset with an energy tie. And you can go and talk to people in emerging markets who will tell you, this thing saved my life, in these really extreme circumstances. So for me, I own a bit. I like it. It's a neutral reserve asset. It is performing as a competing neutral reserve asset would do at a time where people believe, they still believe the Fed's going to do it. They think they're going to stamp out inflation. Now, the math tells you they can't. And that's why I say, okay, Luke, do you still like Bitcoin? Yes. Well, why? Because the math can't work. And basically, unless we get sort of the miracle solution, which is increasingly looking like a Hail Mary, a 99-yard Hail Mary, then this is going to have some sort of a messy outcome. And I want to hedge that. And it is, I think, part of a solution, a group balanced solution to hedging that. And I think that balanced solution includes dollars. I think it includes gold. I think it includes Bitcoin. I think it includes stocks. I think it includes some real estate. I think it includes a whole bunch of different things. But I think it's part of that solution. It has some unique properties that all of those others don't have.
Absolutely.
Yeah.
One of the things that I think we would encourage people to recognize, as you just said, which is never leverage Bitcoin. If you've been doing it in the last 6 months, you learned a really hard lesson. Don't leverage it. This thing could go in any direction from here, including 50% less than the point it's at. So don't leverage Bitcoin is all I'm trying to say for everybody listening, because it will probably be very similar to that gold chart in Weimar, Germany.
Yeah.
Has so far.
Luke, the market cap of Bitcoin is still, it's remarkable, but it's tiny. Do you envision a future where the market cap's much larger and energy settles in this? Or do you think that's far-fetched? What's your thought on that?
I think it depends on, I think it's possible. I think it's still far-fetched for the moment.
Yeah.
But I think it depends on events. The longer this goes on, and what I mean by this is just take the last 2-3 months in energy as it relates to Japan, Germany, Russia, China, we're in a giant prisoner's dilemma, right? And so basically, the longer this goes on, and what I mean by this is the domestic populaces of all these places not being able to afford to turn the lights on, and the more likely it becomes daily that one of them breaks ranks. And the solution to the energy problem is very simple. If I'm Europe, I call up Russia and I'm like, listen, we'll pay you in euros, and to lower the price, we agree to also attach instead of paying you, I don't know, whatever we're paying right now, I'm just going to make up a number. Instead of paying you €100 per barrel oil, we're going to pay you €20 per barrel oil plus 5 grams of gold, physical, delivered to you, valued at €3,000 per ounce. Boom. Their energy bill collapses.
Yeah.
Their energy bill collapses. And people go, well, why would Russia take the deal at a discount? Oh, by the way, Russia's selling at a discount as we speak. Why would Russia take the deal at a discount? What did I say earlier that Russia's been buying the whole time? Gold. So now the 3,000, Russia will be valuing their gold reserves up to €3,000 per ounce by virtue of their oil that they're selling to the Europeans with the kicker.
Okay.
So this is the prisoner's dilemma, where I think the U.S. in particular, certain EU policymakers are trying to keep everybody inside the tent pissing out.
Right.
But the energy side is putting domestic political pressure on European policymakers, Japanese policymakers, less so to the American policymakers because our energy inflation isn't as bad as these other places yet. But it might get there. We'll see.
Do you?
But this is. Yeah, Bitcoin could be a solution to that. I'm sorry, go ahead.
No, I'm sorry to cut you off. What is the most likely way you see this developing in the longer term? Do you think we could see some kind of a Bancor system, as Keynes proposition back during Bretton Woods 2? Do you think that could include some commodity backing of that, whatever that is? Do you think maybe Russia tries to move to commoditize the ruble, as they seem to be doing, and try to make that a more multipolar financial world? And then with all of that, do you see Bitcoin being potentially something like a Bancor, which is a neutral asset that people could, I guess what I'm asking is what do you assign probabilities for these different outcomes? Like a Bancor, Bitcoin, being a world reserve currency, and a multipolar world where everybody's kind of running their own currency for some long period of time?
I think the odds of a Bancor neutral reserve solution is probably, as we look at intermediate term, I think it's well over a 50% chance. Like I think, and maybe that's because I'm an optimist, because ultimately the other side is horrifying in terms of the outcome.
Yeah.
I mean, Russia is sort of already doing this. It's interesting to me to see the people sort of poo-poo what Pozar wrote earlier this year about Bretton Woods 3, and it's never going to happen, a commodity-based money, right? Russia's doing it.
Right.
Russia's basically backing the ruble with gas.
And the second they started doing it, the chart just, V'd right straight up.
Whoop.
Yeah.
Straight up. And so it's interesting to me, right, when I see the UAE, right, world's biggest gas exporter, I believe, I think I saw Russia tell the Indians to pay for gas in dirham, in UAE dirham, right, their currency. Russia just showed you, right, there's always been all these energy producers, their currencies are pegged to the dollar, and so they can't get away from the dollar because their currency collapsed. True. Russia just showed how to do it. If the UAE says we're going to depeg from the dollar and you have to pay in dirham for our currency, the dirham's going to skyrocket against the dollar, just like the ruble did. They will have the problem of having to weaken the dirham the same way the Russians are now. They actually have people in Russia, companies saying we need to weaken the ruble. The ruble's too strong. So Russia has sort of opened this Pandora's box toward this Bancor solution system. I think the Chinese are completely on board. They have been for a while. The Europeans, I think half are. I think they love having the Americans provide their defense for them, but they also want to decide their own energy policy. And so they've got to decide, sort of within their internal political strife, what they want to be when they grow up. Do they want to be energy sovereign, or do they want to, get free defense from the U.S., from the people that are selling them gas, which is sort of as ridiculous as it sounds when you say it out loud. And so I think the odds are, in the intermediate term, are quite high that we move towards some sort of this Bancor solution. And to be clear, this is really good for America. It's really good for the American middle working class, the American government, American military, all of it. It's really, really good. It's just, It's bad for a narrow stretch of Washington, D.C., kind of in the short run, and that's all Washington, D.C. cares about. And it's the short run, and it's not great for the real value of the bond market. But like this just in, the debt levels are so high, and the energy situation that we talked about before is getting so dire that debt is not going to get paid back in real terms or nominal terms. But in one way or another, it's going to get haircut.
Yeah, it's past the point of no return.
Yes.
I mean, this is to enter our world a little bit on that theme. Like, we have a pension. You can laugh. And honestly, like the most tangible thing we're telling our peers that we love and care for is like, you've got to hedge this pension, man. You have to. Like, even in its current setup and where it's likely to go in the future, where I think mandates are going to increase. I mean, there's going to have to be a buyer. Someone's going to have to be mandated to buy this shit, right? And it's very likely that these funds are going to be the bag holders. Sure, there could be bailouts, whatever. But I agree. It is mathematically past the point of no return. There is at least going to be some way, shape, or form of haircut, and you have to be individually hedged against being totally hitched to that cart. I'm sure you agree. I guess take the stand if you're talking to a firefighter who's completely banking on a pension to be their sustenance in perpetuity.
I mean, I think I told you guys when we set this up, my father-in-law, my late father-in-law, was a Teamster official in Cleveland, and my mother-in-law is still drawing a pension from Teamster Central States, which once upon a time, you go back to the 60s and 70s, like that was, I mean, they friggin' built Vegas, right? Yeah. It was immensely powerful. It was inconceivable that the Central States Pension Fund, I'm sure it was inconceivable. I wasn't there then, but it had to have been inconceivable if you would have gone back to 65, 68, 72 and said, here's what Teamster Central States Fund is going to be sending to its pensioners in 2022, in 2014, which is we are in rundown mode. We are going to run out, and it's my father-in-law's other pension too from local, the local that he helped manage for years. Same thing is we're just trying to glide it down, but it's something you have to be aware of and be cognizant of, and just understand the math is the math, right?
Yeah.
The actuarial math is very straightforward. You got a discount rate, you got assets, you've got future liabilities. You've got future return assumptions, and so you can sort of look at it and go, okay, like either it's going to work or it's not. And you can stress test it. These actuaries, they know it's, and that's a little bit of what's been so frustrating. It's sort of how we've managed things as Americans, as Europeans, as humans, and some of it's, I think, just human nature, mostly human nature, right? Is none of this stuff is a surprise, right? I mean, you had 75 million boomers born. It stood to reason that 65 years later, 60 or 75 million boomers would reach age 65 and demand Social Security.
Yeah. Hey, Luke, really quick before we let you go, 2 questions.
Sure.
How would you recommend people protect themselves best in the next decade or so? I think energy sounds like would be something you're a proponent of. Gold, maybe a little Bitcoin. Anything else in that mix that I didn't just mention?
Yeah, I think you need to be. I go back to what I call a Jacob Fugger allocation. So Jacob Fugger, Fugger, was said to be the richest man in history as a percent of sort of the global economy at the time. And he had a quarter of his money in basically cash, a quarter in gold, a quarter in equities, a quarter in real estate, and he rebalanced based on whatever was happening. And I think, I don't know if those are exact things, but I think understanding the combination of the debt and the combination of the energy situation, I think requires you to think in balanced terms. So I think you want for the average investor, you don't need to be buying, volatility ETFs and stuff like that. It's a bad idea. You're going to lose your ass. You're going to lose the money. Like, you need a volatility hedge. That volatility hedge should be a pile of cash in a bank below, it's crazy, below the FDIC insurance number, right? Which I think is $250,000 after 08, right? So you've got a pile of cash. I think you have some physical gold all out of the banking system. There's different private vaulting areas or companies in major U.S. cities. I think you own a little bit of Bitcoin. For the average person, given the volatility, it doesn't have to be much. It's like 1-2%. For the average person, that's probably the right number. Small enough where you're not looking at it up and down every day. You just buy a little, you put it away, and move on. I think you want to own different real estate vehicles. Like one of my favorite stories, Joe Thomas of the Browns. Apparently, I don't know if the story is apocryphal or not, but I'm told that he bought a bunch of farmland as he got paid, right, in the NFL. And I told my sons, I said, "What a brilliant dude!" Right?
Yeah.
Like, it's boring as hell. But all he does is clip a friggin' coupon every year that is truly inflation hedged, right? Mm-hmm. It's not what the government says inflation is. It's what corn and wheat, right? So I just thinking in terms of these, that's an energy derivative, right?
Yeah.
Rental houses, depending on, if you know the neighborhood and so it's this diversification across with a hard asset commodity inflation bent, and the pile of cash is your sort of your downside volatility hedge within that.
Luke, we do this every single episode. We manipulate our guests where Josh says he has the last question, and then I come in with the last question. But two quick rapid fire questions at the end. What concerns you about Bitcoin? If you had to pick one thing, like, hey, this is why I think it could fail or not be as big a deal as a lot of these crazy people on Twitter think. And then lastly, someone on Twitter asked us how much you squat. Let's close with those two. Let's close with those two questions.
I put an engagement post up the other day with 315 on the bar.
Nice.
I did that for 5 reps. So
nice.
That's not
proud of you,
not
Luke.
Bad for my
proud
age.
of you.
That's pretty awesome,
that's
man.
Bad. I felt it the next day, to be clear, but I did it, so that's what matters.
Back surgery, back surgery is in your future, but you got it up. Yep.
Yeah. We'll hook you up with Jason Sansoni.
Yeah.
So what concerns me about Bitcoin, I think it is more regulatory, governmental, just the unpredictability of that. I mean, clearly there are some policymakers, DOD people that get it and understand the value of having a neutral reserve asset for the good of America, the good of American power, the good of the American economy, the good of the American people. There is still, I think, a lot more that see it as the, it's a threat to the dollar and we have to, do whatever we can to handicap it. And I understand it's very difficult to do for all the reasons, but they can make it really, really, yes, they can't take it and say it, but they can make it really, really hard to use without going to another country or doing something really, I don't want to give up my passport. I love America. I'm not going to move somewhere else so that I can use my Bitcoin. There's things they can do, and that's more where I get concerned. The volatility is what it is. That's just a function of managing position sizing, right? If you're sitting there worrying about what your Bitcoin's doing today, you're too big. Get smaller, right? So that's that's really it, I would say.
Yeah. All right, give our audience a handoff to you, FFTT, where people can find you and inhale your plethora of pretty incredible ideas.
Oh, thank you. If you're interested in learning more about our product offerings, either institutional or mass market, it's fft-llc.com. And I've got a pretty active Twitter feed at Luke Gromen, LUKEGROMEN, all one word, on Twitter.
Luke,
thanks,
this was
Luke.
fantastic, man.
We'll be awaiting the invoice.
Yeah.
Just if my house catches fire, please. We'll call it even.
Sounds good.
Send the invoice to what Bitcoin did at Gmail.
Peter said he'd cover us. He gave us the old head nod.
Thanks, Luke.
I love it. All right, guys. Thanks for having me on. It was great talking.
Take care.
Likewise.